I'd like to start with one of the most eminent political theologians of our time from the University of Nottingham, one of the founders of the radical orthodoxy movement, although he has some distance from it, and the author of the Theology of Money and Capitalism and Religion, in other words, radical contingency and the valuation thereof. So, Philip Goodchild.
Have you not heard of that madman who took a bar of gold into an electronic exchange, ran onto the trading floor, and cried incessantly, "I seek Mammon! I seek Mammon!" As many of those who did not believe in Mammon were standing around just then, he provoked much laughter. "Has he been sold?" asked one. "Has he gone bankrupt?" asked another. "Is he in the bar? Is he in the gentleman's club? Has he gone to China, an offshore tax haven?" Thus they yelled and laughed. The madman jumped into their midst and pierced them with his eyes. "Whither is Mammon?" he cried. "I will tell you. We have killed him. You and I. All of us are his murderers." But how did we do this? How did we drink up the great sea of wealth? Who gave us the sponge to wipe clean all the ledgers? What were we doing when we unchained these liabilities from their assets? Whither are we seeking now? Away from all assets? Are we not plunging continually? Backward? Sideward? Forward? In all directions? Is there still any profit and loss? Are we not straying as through an infinite nothing? Do we not feel the breath of poverty? Have we not become poorer? Is not depression continually closing in on us? Do we not need to trade with gold? Do we hear nothing as yet of the grave diggers who are burying Mammon? Do we smell nothing yet as yet of the decomposition of money? Money too decomposes. Mammon is dead. Mammon remains dead, and we have killed him. Well, here the madman fell silent and looked again at his listeners, and they too were silent and stared at him in astonishment. At last he threw the bar of gold at the screen, and it broke into pieces, and he went out. "I've come too early," he said then. "My time is not yet. This tremendous event is still on its way, still wandering. It has not yet reached the ears of men. Evaluation of assets requires time. The payment of debts requires time. Deeds, though done, still require time to be seen and heard. This deed is still more distant from them than the most extended futures contract, and yet they have done it themselves." Well, it's been related further that on the same day the madman forced his way into several banks and there made a plea for bankruptcy. Let out and called to account, he said to have replied nothing but, "What, after all, are these banks now, if they are not the receivers and bankruptcy administrators of Mammon?" Well, I'd like to thank Bob Meister and Stephen Bruce for making this possible. And I was tremendously impressed with the panel we heard last night and wondered how to follow it. And Stephen just said to me, "Be provocative." So I will. Not one of you will agree with every word I'm about to say. I hope. Anyway, there's a story goes that Governor Elizabeth Duke of the Federal Reserve reported an anecdote from just after the failure of Lehman Brothers. Ben Bernanke, chairman of the Federal Reserve, was asked, "Well, what if we don't do anything?" To which he replied, "There will be no economy on Monday." A similar thing happened in the United Kingdom. The chairs of the major banks were summoned to the Chancellor of Exchequer that weekend, and they told him, "Unless you do something, the ATMs will not operate on Monday morning." there will be no cash. Well, what is wrong with the global financial system? That's what I want to consider. The global financial system has been constructed to serve three economic imperatives: the need for growth, the necessity for efficient allocation of resources, and the maintenance and enhancement of credit, grounded in stability. The recent financial crisis demonstrates a failure in each of these tasks. Common wisdom about the significance of the crisis is that it's a Keynesian moment. Individual states have had to step in to maintain growth, allocate resources, and provide stability. But once the global financial system has been repaired through tighter regulation and rebuilt balance sheets, then it may take up the strain once more, leaving states the opportunity to rebuild their own balance sheets. What I'd like to argue today is that this common wisdom entirely misses the apocalyptic significance of the recent financial crisis. What is wrong with the global financial system is that it threatens us with a live and devastating weapon, the possibility of its own implosion. Such an implosion matters for three essential reasons. Banking networks are scarce resources. We don't have too many of these networks. We can't really buy and sell without our current network. Banking networks also hold and preserve nearly all of our liquid wealth in the form of deposits. And we would lose all this wealth if they went bankrupt. And the global economy is a complex network of interlocking liabilities. Failure of Lehman Brothers placed many others at risk of being forced into default, threatening to unravel the entire system of liabilities and preventing any institution from evaluating the net worth of any other. We would lose all knowledge of the creditworthiness of all institutions. So what's at stake here is that major financial institutions are at once players within a financial system as well as conditions for the survival of the system. And this is why taxpayers have been forced to offer a free insurance policy to underwrite them. It's a matter of economic survival, not political ideology. So the financial crisis is apocalyptic in an ancient biblical sense. It's a disclosure of underlying powers. Political decisions have been shaped by economic forces, and far from a return to state sovereignty over economic affairs, the current crisis discloses the submission of the state to economic forces, often in complete opposition to the ideology of the state leaders involved. The global financial system exercises its power of coercion through its own fragility. Coercion through fragility. And it's this predicament which discloses the problem I would like to consider this morning. What's the significance of this strange power of coercion that is exercised through weakness? Well, economic theory is caught in a dilemma in its treatment of human agency. On the one hand, it assumes that human beings are autonomous rational actors, intent on maximizing their own self-interests and exercising free choice. But on the other hand, it attempts to determine the laws that govern actual economic behavior, as though people behave entirely like fully determined particles. Now, this dichotomy can be resolved only if the laws governing behavior are also the explicit reasons for free action. For example, seeking economic growth, allocating resources efficiently, preserving creditworthiness, These seem to be criteria of rational conduct that apply to individuals, apply to businesses, and apply to governments alike. These reasons for economic conduct become self-reinforcing to the extent that they are conditions for prosperity and influence. Those who are not rational actors in this specific sense will not remain significant actors. Skip a page. So whenever we take the most profitable course of action, we evaluate the world in terms of money. Money as a unit of account becomes a medium through which we think and through which we evaluate the world. Rational conduct is expressed in determinate acts of sale or purchase at determinate prices. Now, the value of money is not empirically evident. No one has ever seen or touched a dollar, apparently. Forever since the invention of stamped coinage by the ancient Greeks, money has itself consisted in a promise to pay, or perhaps more accurately, a promise to receive. Money holds value because it is acceptable as a means of payment by some issuing authority, whether that payment is for taxation or to pay interest. Money only holds value as a liquid asset because there are liabilities. Our liabilities and obligations underlie our economic reasons. The entire world of money, prices, and accounting is a medium of expression for liabilities. Far from being a neutral object entirely under human control, money expresses a network of social obligations and liabilities that controls us. And this is rather strange because all our modern knowledge has been constructed from the perspective of advising sovereign states, sovereign corporations, sovereign individuals about their possible courses of conduct, their possible choices. But if this autonomy is an illusion, because our material needs and social liabilities pre-exist us, then our modern world isn't based simply on knowledge or on reason, on evidence. It's also been built upon promises, markings on coins, paper currency, account books, bank statements, credit ratings, balance sheets, price charts. These have been essential because they record temporal expectations and promises. Our modern human civilization, like ancient ones, has been constructed on the basis of faith in promises. That is, in terms of powers that are not demonstrable, cannot be subjected to experimental proof. For the fulfillment of a promise depends not merely on the virtue of the one who promises, but also on the cooperation of other powers. There's an interdependency. And whether these powers have been conceived as ancestors, spirits, fates, gods, divine providence, human authorities, sovereign powers, or market forces, perhaps understood as contracts, bonds, liabilities, foreign currency reserves, financial derivatives, even the national debt. Human conduct is made predictable when it can rely on the blessings of unseen powers. At least there's a national debt. We can rely on that. And human conduct itself becomes reasonable and worthy of trust when it becomes predictable. Well, this is how religion works. Our obligations and liabilities make us predictable and ensure cooperation. So this is why I think there's scope for a maverick philosopher of religion to assess the hidden economic powers that are themselves the reasons for human conduct. In general, our illusion of autonomy keeps these veiled beneath human agency. It's difficult to read from one's own thoughts and conduct, let alone that of others, the underlying reasons that have shaped it. But the significance of the current crisis, then, is the way in which such exceptional circumstances remove the veils and disclose the nature of the social reality in which we live. At last, we see the financial system exercising naked coercion upon supposedly sovereign states and supposedly autonomous individuals alike. Yes, to buy or not, to invest or not, to bail out or not, these remain human choices. But if the alternative is failure to survive, then any free choice is made under conditions of extortion. And just as we may suspect that an extortionate price is not reasonable, we may also suspect that an extortionate reason may not be entirely reasonable. So I'd like, bearing these thoughts in mind, to turn to the recent crisis and ask first, how is it that economic forces escape human control? Well, climate change offers an instructive parallel. Positive feedback processes in the Earth's climate imply the possibility of a runaway or abrupt climate change. And while the trigger that causes the climate to leave its stable state might be anthropogenic, the consequent course of climate change is not. The climate will return to its more common condition of instability, with massive changes of temperature. While political efforts are currently attempting to ward off such a possibility by limiting the temperature rise to a further 2 degrees, in reality, we do not know if there is already sufficient momentum in the positive feedback processes already underway, or in human habits of consumption, or in the global economy itself to make instability inevitable. Well, economic crises have a similar logic of self-reinforcing or positive feedback processes. Once triggered, the collapse in confidence and fall in asset values becomes inevitable. There's something counterintuitive here. Surely euphoria and fear, confidence and mistrust are human emotions. They're capable, surely, of management by reason and effective institutions and regulations. Well, in practice, such management has been conducted through hedging and insurance, precisely the conditions for extending leverage and instability. So we must confront the fundamental question. Could it be that the global financial system, even in its periods of growth, is a kind of runaway train? Amazing what you can find on the internet. A machine built by humans but no longer under human control. Could it be that we cannot switch off the power or pull the brakes because the economy holds a hand grenade to our heads, the possibility of its own implosion? And indeed, could it be the case that the economy has crashed precisely because Ben Bernanke and others sought to gently apply the brakes? Well, there's a widespread view that human agency is correlated and supported by structure. A railway infrastructure, for example, enables train journeys, but does not determine which journeys will be taken. So while economic decisions are free, an economic infrastructure is shaped by political decisions, so embedding economic processes within a wider political economy. But if this railway analogy is to effectively model coercion, natural selection, and positive feedback processes, then perhaps the railway system may be one where nearly all routes are dead ends, or where the points are already set preventing certain journeys, and where the downhill slope on the remaining route may become progressively steeper, so that the brakes can no longer cope with the speed. Imagine cycling around this beautiful campus but not stopping. And every intersection, you have a free choice. If you're feeling energetic, you're going to take the turning that takes you uphill. If you're feeling a little bit tired, perhaps you'll take the downhill one for a bit. You can travel wherever you wish. We know where you're going to end up. Downtown. Well, this is my understanding of economic causation. States, businesses, and individuals are subject to economic constraints. They do not have a monopoly of wealth, but rely on credit from others, and so operate within the guidance of economic forces. So I think it will be helpful at this moment to provide narratives of three aspects of the current crisis, two of which may be very familiar, in order to disclose how autonomous processes operating through positive feedback, natural selection, and coercion have become the reasons for taking disastrous decisions. So these will be my three narratives about subprime loans, global imbalances, and limits to growth. Well, many commentators and journalists attribute the crisis to the rash of issuing subprime loans. Yet until the crisis, such loans may have seemed entirely rational. You might find that hard to believe, but I'm going to try and persuade you for a couple of minutes. Let's examine a hypothetical ninja loan, one of those lent to someone with no income, no job, no assets. It's someone's dog. They take out a loan. Right, suppose that such a person or dog takes out a 100% mortgage on a property priced at, say, $100,000. I have a table. With an interest rate of 4%, but with property inflation running at 10% per annum. It's a hypothetical scenario. After the first year, the property will be worth $110K. The interest of $4K can be refinanced, added to the mortgage, leaving equity of $6K in the property. After 10 years of this, the property would be worth $259K, the mortgage $148, leaving equity of $111K. Now, supposing this canny canine investor releases half the equity in the house as a deposit for a second identical property worth $259K, and lets the second property for a rent that covers the new mortgage. If I've done my figures correctly, they continue to refinance the interest payments as before. Then after the subsequent 10 years, the second property can be sold on for $672K, paying off the total outstanding debt of $505,000, leaving outright ownership of the first property, now worth $672, and a lump sum in capital, very nice, of $167,000. The investment then is entirely rational, unless one has reason to question expectations of continuing property inflation and reasonably low interest rates. Our ninja, our canny canine, has nothing to lose. But perhaps the bank should know better. Is it rational to offer such a loan? Well, if the borrower defaults, the bank can repossess the property, recover most of the loss, sell it on to the next ninja. Is there a risk that prices will fall? Well, if banks continue to offer such ninja mortgages to anyone, there won't be a shortage of capital to buy property and no need for prices to fall. Leveraged loans continue to pump up asset prices. It was rational after all. Even in the worst-case scenario of a recession, one can rely on the Federal Reserve to reduce interest rates and open up the money supply, so maintaining the demand for property that keeps prices rising. In short, the subprime lending was an entirely rational phenomenon, effectively secured by the real asset of property and insured, in theory, if not always in practice, by the spread of risk through the financial system by selling on CDOs, and further insured by CDSs. Leveraged growth through asset price inflation was a sustainable model of economic growth. so long as the entire financial system advanced together and in step. Even if the risks posed, if deleveraging were to occur, as it did, were so severe. So here we have a positive feedback mechanism that creates a virtuous circle of wealth creation, where money is made out of money, which is made out of money, which is made out of risk. Of course, the entire system is dependent upon a fresh supply of credit for leveraged growth. And this brings us to a second narrative of the crisis, the one that is told by economists and we heard last night from Prabhat. It's about the unsustainable imbalance between consumer and producer nations, especially the United States and China. China's extraordinary economic growth has resulted in and been fueled by a savings glut by Chinese individuals and corporations. Some of the reasons for this are specific to China and amount to the need to provide for a kind of insurance. The disappearance of collective farms and the reduction of state corporations leads to a loss of security provided by these. The one-child policy, meaning that 4 grandparents must share a single grandchild, has meant that the current generation cannot look to the younger one for security in old age. And state-owned enterprises do not redistribute profits through dividends and so are biased towards overinvestment. At a national level, China's foreign currency reserves have been a necessary insurance against financial crises, a lesson demonstrated by the East Asian crisis of 1998 and confirmed by the global crisis of 2008. The glut of savings in emerging markets has been a key factor in the decline of long-term interest rates, making credit readily available for speculative leverage. For dollars found their way back into deposits in Western financial institutions, where they could function as reserves for leveraged loans at official rates approaching 40-1. This savings glut view, sometimes countered by the money glut view, to my mind, they amount to much the same, really. That's that interest rates were held artificially low for too long by central banks in order to engineer a recovery from the bursting of the dot-com bubble and the subsequent decline of the stock market. Such low interest rates were then responsible for a speculative bubble in property and the attractions of higher rates of return from securitization as opposed to low-yielding treasury bonds. In either case, the United States has been enjoying the privilege of seigniorage, the acquisition of resources through printing money, specifically in the form of imported consumer goods and the ability to deploy a large military force overseas. Moreover, the Asian countries had a vested interest in maintaining the value of the dollar in order to maintain the value of their own dollar-denominated savings and reserves. Dollar hegemony is sustained by the need for insurance against further financial crisis in a positive feedback loop. The global financial system was driven by the printing of money in the United States, secured against speculative bubbles in property and securities. And on this account, current plans to fix the global financial system will merely sustain this imbalance, leading to a future repetition of the crisis, or this being the effect of impersonal economic forces. In essence, then, such a global imbalance is a repetition of the class system on a kind of international level, where resources, commodities, capital, and skilled labor is transferred from the developing world to the developed world. One class produces while the other consumes. One class can afford to consume because it can afford to pay for security, while the other is forced to produce because it lacks security. Yet the question here, then, is why did this imbalance, which had been sustained for so many years, why did it suddenly become unsustainable? At this point, I believe we need to turn to a third narrative of this crisis, and it's one that I've been giving since 2002. The crisis expresses the first major collision between exponential economic growth and ecological finitude. Specifically, in the coincidence of high oil prices and a debt bubble. Because while economic growth is geometric, it advances exponentially, the natural resources that power the global economy are finite. Prices for oil, copper, zinc, silver, platinum, wheat, rice, corn, all more than doubled rapidly in the mid-2000s. This might be a rather familiar chart to you, the chart of the oil price. I was at a conference in Edinburgh in 2005, run by the Oil Depletion Analysis Centre that's based in London, where this chart was sketched out in our minds for us by the speakers, including the date of 2008. There's a chap called Chris Skrybowski, who was the editor of a journal called Petroleum Review, who did a thorough study on the new oil fields that were coming on stream, rates of depletion in existing oil fields, and found a crunch point coming up in 2008. So this picture, with both the peak and the following trough, was predicted. No doubt the effect on rising prices of increased demand was amplified by speculative investment in futures, but with rapidly rising inflation in the basics of living, alongside a money glut, the central banks raised interest rates, placing an increased burden on those with subprime loans. And this rise in interest rates, I believe, was the trigger. With high inflation, a high rise in mortgage repayments, defaults quickly rose beyond the level necessary to sustain the speculative bubble in property prices. Only then did the securities based on subprime loans, which had previously been valuable speculative assets, lose their value, triggering the defaults with their knock-on effects throughout the system of highly leveraged assets. With the drying up of credit, the failure of weak businesses, a rise in unemployment, and a drop in demand leading to recession. For given the absolute scarcity of an essential commodity such as oil, and it's not the only one, the only way to reduce consumption is by a rise in prices, leading to demand destruction. Demand destruction means recession. Efficiency savings would have the opposite effect. They would lower prices and so increase overall consumption. Yet when demand destruction involves rapid deleveraging, then instead of returning to an equilibrium price set by supply and demand, there's a tendency to overcompensate. On this account, the global economy will receive repeated shocks each time that demand exceeds supply for an essential resource throughout the current century. Increasing regulation of the banks will achieve very little. And it's important to notice in this account of the crisis that the critical ingredients for economic growth, readily available energy such as oil and the supply of credit, are not entirely within human control. I believe that the recession was caused by limits to energy production and by the lack of availability of credit. Well, the purpose of outlining these narratives of the crisis, and I think they can all be true at once, was to disclose the operation of underlying forces in the global financial system. In the first place, we can observe a range of positive feedback processes that have driven the economy as a kind of runaway train. There's the speculative asset price inflation caused by the issuing of credit at high rates of leverage, with the profits functioning as an increased reserve for further borrowing and speculation, a combined asset price and leverage bubble. Furthermore, there's the ability to insure against all kinds of financial risk produces stability and enables the possibility of undertaking more kinds of risks. For in every securitization, every derivative or insurance transaction, there's always a counterparty. One party seeks to insure against risk, while the counterparty takes on the risk. Risks taken are merely moved elsewhere in the financial system rather than removed entirely. And the financial system as a whole has no counterparty until it demands free insurance from the state. As Hyman Minsky pointed out, stability increases risk. There are the perverse incentives, the bonuses paid to bankers who seek short-term profits by using higher rates of leverage and taking higher risks. Likewise, the incentives for credit rating agencies who were paid by banks who themselves required far smaller reserve requirements for AAA-rated securities. The prices of options and derivatives were formed according to models that only used recent data on price fluctuations, so that economic theory, here the efficient market hypothesis, and financial models had a direct influence on human behavior. And then at the end, there's the downward spiral of deleveraging, where selling assets, requiring more margin, and hedging against further declines leads to a rapid drop in prices, the drying up of liquidity, and the consequent free fall in prices. The use of reserves to cover losses leaves the bank still heavily leveraged. In each of these cases, there's a feedback mechanism between an economic activity and the structural mechanism that makes it possible. That is, between speculating with money and the creation of money, between speculating in assets and asset values, between insuring against risk and taking risks, between creating risks and rating risks, between rational models of the market and actual behavior in the market, and between the banking sector as a major player within financial markets and banking as the infrastructure of all markets. What we have here, therefore, is a level of reflexivity, if that's the right word, but it's qualitatively different from herd behavior, from the herd behavior of financial markets described, for example, by George Soros. There's a reflexive amplification of an economic behavior and an economic structure. These positive feedback processes turn the global financial system into an unstable runaway train. So that's one aspect of what's beyond human control. There's two others I want to get through. In the second place, we can observe a gradual transfer of wealth and power to those who already have wealth and power. The result of the financial crisis in debtor countries is the transfer of resources from the taxpayer to the major financial institutions through the bailout program and through the rise in actual interest rates needed to rebuild balance sheets. Moreover, defaults on mortgages leaves the financial institutions as the owners of property, while individuals remain in perpetual debt bondage. Similarly, the loss in value of conventional investment assets leaves pension and mutual funds to struggle, while the managers of money retain their bonuses and speculative profits. In creditor countries, by contrast, the fall in demand leads to a loss of revenue in production and so an overall loss in wealth. Small businesses have cash flow problems, find themselves unable to refinance their loans and so concede their market share to larger competitors who are perhaps too big to fail. There's a transfer of wealth from individuals to large institutions, and from large institutions to an elite class of managers and investors. All of this then echoes the net transfer of resources, manufactured goods, highly educated personnel, and money from developing to developed nations that occurs when economic growth is driven by seigniorage, leverage, speculative asset inflation, and consumption. And in the third place, there's this problem of the scarcity of resources, which is exacerbated by overconsumption. Without increasing consumption, there's a lack of effective demand, and the global economy slips into recession. Yet accelerating the consumption of finite resources leads to commodity price inflation and demand destruction, intensifying recession. As a result, then, there's less resources available to the population as a whole. So I would suggest that the underlying economic forces that control human decision-making are positive feedback loops, increasing inequity, and scarcity. In order to limit their effects, one might suppose that what is needed is the subordination of the power of finance to the power of democracy, subordinating economics to politics. If these forces have been unleashed in our era of financial globalization and consumer-driven credit capitalism, then the remedy would appear to be the return to the golden age of Keynesianism, with a Green New Deal, perhaps, to generate new sources of energy, massive public spending to boost employment and demand, and tight regulation of financial capital. Nevertheless, whether the economy is driven by the private sector or by the state, the same underlying economic forces are at work. For the problems that have led to the current crisis are merely extreme manifestations of much more deeply rooted economic dilemmas. So this, I think, is getting to the heart of it. There's the paradox of growth. Economic growth is necessary to make profits, to pay dividends, and to repay loans. For at the heart of all commercial activity is the issuing of credit, without which production and distribution for profit would scarcely be possible, since one has to purchase before one sells. And then a shortage of growth leads to a shortage of profits, a lack of available credit, and the vicious cycle of reduced demand, reduced production, reduced employment, until confidence reemerges. Yet, economic growth means a growth in purchasing power, and thus a growth in consumption. And while economic growth and, at times, population growth are geometric, the production of natural resources is cyclical. It doesn't really grow at all. If it happens at all, it's cyclical. So a capitalist economy without growth is impossible. You need growth in order to repay credit. But continued economic growth is impossible. On this account, then, our economic crisis will start to become serious in 2011 as a result of the next oil price spike. I'm relying on Chris Skrybowski again. That will arise when the depletion of production from existing wells is no longer compensated for by the production of new oil wells. So that's one fundamental, inescapable economic dilemma. There's a second one, which we can think of as the redistribution problem. People are remunerated according to their market value related to their contribution to production. Then wealth will accumulate with those who are creators of wealth. And while this apparently results in efficiency, since wealth accrues to those businesses which are best able to make most use of it, it leads to a lack of purchasing power among the wider population, who need to act as consumers to make those businesses profitable. We don't have a problem of overcapacity, we have a problem of under-demand. There's half the world's population lives on less than $2 a day. There's plenty of demand there, it's just they've got no money to pay for it with. Our bubbles of speculative assets and leverage may have been necessary as a solution to the problem of overproduction or under-demand. And state redistribution via taxation and welfare merely makes the economy much more efficient and effective, to my mind, so boosting both economic growth and the potential for inequality. Oh, the historical alternative to excess consumption to address this problem has been warfare, but it's more or less an inescapable problem, the redistribution problem. And the third one is the threat of capital flight. Each nation, each business, and many individuals are in competition for credit or capital investment, without which there would be no creation of wealth. Each must therefore return a profit to capital. There's no sovereign control over the creation of credit, for credit is a relation. It's not a possession. Credit is a relation. So tight regulations over capital movements, as enforced in the past, do not entirely remove freedom of allocation of capital or credit. Only taxation has achieved that, often at the cost of social unrest. So even in an international regime of tight regulation, there may be nothing to stop one privileged nation from unilaterally deregulating, as the United States did in the early 1970s. In that case, then, politics must remain subordinate to economic forces, since credit is an inherently collective phenomenon, and the confidence it appeals to is the confidence of those with sufficient wealth who seek to maximize returns. Political decisions are taken to maximize short-term profit at the expense of long-term stability and survival. These dilemmas, constitute the underlying reasons for our coerced political and economic decisions. If such dilemmas are rarely acknowledged as such in public discourse, this does not make them any less effective. The paradox of growth is felt in the moral imperative for economic growth. That's the one thing that we can more or less all agree on. We need economic growth. Nearly all of us could agree on. The distribution problem is felt in the moral imperative to increase efficiency. It's seen as a moral imperative. We must be more efficient. And the threat of capital flight is felt in the moral imperative to maintain credit. These are moral obligations. In each case, the alternative is the threat of economic failure. Nevertheless, the dilemmas are insoluble in liberal capitalism and in state socialism alike. An economic apocalypse is then inevitable. So, moving towards my conclusion, you might be glad to hear. The modern attempt to restructure the world in accordance with reason has been an attempt to discover an immanent order of nature, whose working could be systematically understood and explained in its own terms. The purpose of understanding such an immanent order of nature is to eliminate contingency and insure against risk. Conduct must be regulated by reason. The paradigm of such an immanent order in the practical sphere, in the sphere of what we actually do, is the self-regulating market, a market which regulates itself by efficient allocation of resources. And indeed, independence from political or moral interference is what a self-regulating market means, and efficiency is the sole rational criterion that it admits. Yet reason is a means to an end. It is not an end in itself. Our attempt to construct a system to regulate economic behavior and guide choices has amounted to a subordination of all other reasons to efficiency. This amounts to a formation and selection of a perspective, a way of seeing the world, a way of acting that excludes all others, willfully making itself morally blind. If this much is obvious, why is it that calls to subordinate economic to ethical ends have little or no practical impact? The recent papal encyclical from Pope Benedict last July was an attempt to do precisely that. Well, while a free thinker may hold any perspective they're capable of constructing, a significant perspective has to be externally validated. And this is what an economy achieves. One may make any demand one wishes, but unless this demand is backed up by money, it will be ineffectual. Money is the social delegation of effective demand. One may enter into private contracts at will, but unless these contracts are recognized and legally enforceable, they'll have no binding power. One may write IOUs and offer them as payment, but unless they're supported by legal tender, as money that is recorded by banks, for example, then they might be rejected. So economic value is not grounded in utility, it's grounded in reflexivity. The value of an asset is the promise of the money that may be exchanged for it. The value of money is the promise of the assets that may be exchanged for it. And while consumption goods may hold some value through utility, assets and money hold value through confidence. If money is essentially a promise, essentially credit, then its value rests in external confidence or validation. That is, the perspective of some anonymous third party in some distant and future place. And this validation, in turn, is validated by external confidence, a further fourth anonymous party. So that economic value is confidence in confidence in confidence in confidence. The asset leverage bubble reveals the true economic nature of economic valuation. It doesn't touch down in reality at any point. It's entirely blind. Then, insofar as the economic system measures efficiency in terms of profits, that is, in terms of money, economic conduct is entirely regulated by what is profitable, and only subsequently by what is worthwhile. Money only measures money. Free human political and moral evaluation is excluded, except insofar as consumers can be found to pay for it. And since money can only be spent or invested or given away, individual ethical evaluations are reduced to simply a choice of pleasures, a balancing of profits against risks, and philanthropy based on sympathies, each in competition with the others. The perspective from which the world is seen then is that of individuals or corporations or governments who've got money to spend, not that of communities of mutual obligation. Since it's more profitable in the short term to consume inherited and accumulated assets than to produce them, an economic system which measures only the creation of profits will necessarily result in the destruction of wealth. But I have one more vital phenomenon to consider. Money circulates around the economy. It flows back to the banks. While any economic agent might undertake a high degree of leverage by borrowing money or might lend money, there's a certain privilege held by the banks. When customers borrow money and spend it, the recipient might have an account with that same bank and so deposit the money once more. Imagine taking out a large mortgage, buying a property, transferring your money to the person you're buying it from, and they bank with the same bank. The money never leaves the bank at the end of the day. The reserves need never be transferred. And in effect then, the recipient lends the money to the borrower, so that the money is simply created as a new asset and liability. And in this clearing system as a whole, it doesn't matter if it's the same bank. Most exchanges cancel each other out, leaving a small net flow of reserves in relation to the total transactions. Banks do not need to borrow in advance a large proportion of the money they lend, because it simply returns to them the same day as deposits. Of course, if there's a large default on loans, then reserves may be needed to be sold in order to cover the liabilities, increasing the degree of leverage. Yet money is largely created by banks lending in excess of reserves, so long as they advance together and in step, as Keynes pointed out. There is, though, an advantage to those banks that advance a little bit faster, that undertake a higher degree of leverage. They can be more profitable, but also more risky. And then it becomes a bit of a race. You don't want to fall too far behind the leaders, but on the other hand, if they get too overextended ahead of the rest, then you don't trust them anymore. Well, this is the privilege of banks, and yet this privilege can also be possessed by those who create derivatives. Because it's not only money that can be created in this way. In a similar way, assets can be created by shorting them, selling them before purchasing, and by securitization and the construction of derivatives. Speculators can create valuable paper assets by selling and buying them. And what's decisive here is the ability to write credible paper assets. The ability to create economic value is a privilege accorded only to those with the ability to create economic value. Sorry about the tautology, but there it is. The entire productive economy is dependent upon and driven by this reflexive value of money. Now, I think this phenomenon of increased leverage through securitization is decisive, even if it reveals the true nature of modern money as it has been since the founding of the first central banks. As it's been put by George Cooper. Is he coming next? Oh, sorry, I've done that. There is no more powerful mechanism for the short-term amplification of corporate profits than to persuade some element in the economy, government, household, corporation, to spend above its income. Conversely, there is no surer way to erode corporate profits than to permit any of these groups to save their income. So the economy is driven either by Minsky's paradox of gluttony or by Keynes' paradox of thrift, without there being any stable equilibrium point. And while it's theoretically possible for central banks to ensure some stability by controlling credit, forcing the economy to oscillate between these two, the economy as a whole cannot operate without an adequate supply of fresh credit. So overall, any engineered stability has to remain within a longer-term credit bubble. Excess credit can only be removed in the end by default and inflation, transferring wealth from the prudent to the reckless. Really concluding now, if our era has seen the financialization of culture so that we all learn to see the world from the perspective of money, such a culture is the effect of an autonomous economic process. It's an effect rather than a cause. In this respect, the economic apocalypse has already happened. We have all become blind or impotent. The underlying and invisible force that operates through the human will has four principles, and I call this the theology of money. The value of money is transcendent. It's a promise taken on faith and only realized to the extent that this faith is acted out in practice in contractual exchange. That's the first point. We're dealing with a value that's never been seen. It's a promised value. Secondly, money is the supreme value because it's both the perspective through which we value the world and it's our means of making what we value real. We make it real by spending the money on it. We want something to happen that we really value. We spend money on it. Demand is effective when money is spent. Since money is the means by which all other social values may be realized, it's what you've got to get hold of first. It posits itself as the supreme value. Thirdly, financial value is essentially a degree of hope, expectation, trust, or credibility. Financial value is promised. Yet, financial value measured by money is our underlying reason, the discipline for our conduct, the pivot around which the world is reconstructed, being transcendent to material and social reality, yet also being the pivot around which material and social reality is continually reconstructed. Financial value is essentially religious. And then the fourth principle is that the entire monetary system has its own intrinsic logic of growth. This drive for growth is a separate engine of the global economy in addition to individual acquisition of necessities and the individual pursuit of self-interest. There are three relevant components of this engine. There's a logic of appropriation. Speculative profits can only be made on the basis of profits extracted from production and consumption, and to achieve this, an increasing quantity of the world's physical resources, as well as an increasing quantity of the world's moral ends, must be appropriated for production, exchange, and consumption in a colonization and commodification of the world that intensifies scarcity. There's a logic of natural selection. Wealth brings access to power, and only the powerful and wealthy shape the world so that they can become more powerful and more wealthy. The economy tends towards inequality and oligopoly. And then there's also a logic of intensification. Increased production and profits require increased investment, credit, and debt. The entire global economy is driven by a spiral of debt, constrained to seek further profits, and always dependent on future expansion. The entire global economy has, since the founding of the Bank of England in 1694, in its most nascent state, been a bubble of speculation and leverage. So here at last is the ultimate power of coercion towards growth, efficiency, and credit. I finished.